Something just snapped in the global financial system. And the sound it made wasn't the crash of a price chart. It was the sound of doors slamming shut. While you were watching silver attempt to breach $86, 2 emergency meetings were happening simultaneously, one in Chicago, one in Washington, both designed to stop what they knew was coming. The first meeting lasted 30 minutes and changed the rules of a market that has existed for over a century. The second meeting involved the 7 most powerful finance ministers on earth discussing a single word: shortage. But here's what they didn't tell you about the mathematics behind the margin hike. The 15% increase was precisely calculated to force maximum liquidation with minimum political exposure. The CME analyzed every major silver position in their system. They calculated the cascading effect would drive the price to $78 within hours. The mathematics were sound. The strategy was proven. It had worked flawlessly in 2011 and during the 2020 crash. But they miscalculated the Shanghai factor. They miscalculated the speed of arbitrage flows. Most critically, they miscalculated the amount of genuine shortage underlying the price move. In previous cycles, margin hikes worked because the rallies were speculative, built on leverage. This time, the leverage was already gone. The rally was being driven by Samsung needing silver for batteries, by Tesla needing silver for vehicles, by Raytheon needing silver for guidance systems. You cannot margin call Samsung. You cannot liquidate industrial requirements. Industrial demand doesn't trade on margin. It trades on necessity. The CME fired a weapon designed to kill speculative demand at a market driven by industrial demand. It was bringing a financial calculator to a physics problem. The physics are unforgiving. 2.2 million ounces drained in a single day. At current prices, $187 million of inventory removed from the Western system, gone, shipped to facilities that will melt it down and turn it into products that will never return. The drain isn't linear. It's accelerating. 3 months ago, daily outflows averaged 800,000 ounces. This week, 2.2 million. The progression is exponential. The surface event looks straightforward. Silver climbs to $86. The Chicago Mercantile Exchange issues emergency notice 26/019, new margin requirements, 9% of notional value instead of fixed dollar amounts. Translation: the cost of holding a silver contract just jumped $6,000 overnight, from $32,500 to $38,250. A 15% increase that took effect immediately. Standard market management, they told you. Routine volatility control. Nothing unusual about exchanges adjusting margin requirements during price spikes. Then why did the Treasury Secretary call an emergency G7 meeting on the exact same day? This is where things stop making sense. Treasury Secretary Bessent didn't convene the finance ministers of the world's 7 largest economies to discuss climate change or tax policy. The official communique mentioned one phrase: securing supply chains for critical minerals. Critical minerals, not precious metals, not commodity markets. Critical minerals, that's not market language, that's war language. When governments start classifying silver as critical, when they start talking about securing supply chains, they're not managing a market. They're preparing for shortage. They're acknowledging scarcity. They're admitting the flow has stopped. But the timing reveals something darker, something coordinated. The CME fires its margin weapon at the exact moment the Treasury admits supply vulnerability. One entity tries to crash the paper price. Another entity scrambles to secure physical metal. This isn't coincidence. This is the sound of a system fragmenting in real time. And here's what should terrify you about the coordination. It failed. In every previous cycle, margin hikes worked. They worked in 2011 when silver crashed from $50 to $35. They worked in 2020 when pandemic selling drove prices to $12. Margin calls force liquidation. Forced liquidation creates price collapse. The mechanism was reliable. Silver hit $86. The CME hiked margins 15%. The price dropped $2.50 to $83.57. Then it bounced. Then it recovered. As of this moment, silver trades at $83.90, a $2 dip on a 15% margin hike. In 2011, a smaller margin increase caused a 30% crash. Why didn't it work? What changed in the structure of the market that makes their primary weapon ineffective? The answer lies 7,000 miles away from Chicago. It's called the Shanghai Shield. And it represents the most significant shift in global commodity market structure since the collapse of Bretton Woods. While the CME was busy trying to smash the price in New York, the Shanghai Gold Exchange closed its session with silver fixed at $93.31. The spread between paper and physical, between West and East, between theory and reality had reached $10 per ounce. This spread is unprecedented in modern precious metals markets. During the 2011 silver rally, prices in London, New York, and Shanghai tracked within pennies of each other. The global market was unified. When New York sold, everyone sold. When London bought, Asia followed. Price discovery was centralized in Western financial centers. That unity is shattered. The market has bifurcated into two separate pricing systems operating under completely different dynamics. The West trades paper contracts backed by declining vault inventories. The East trades physical metal backed by massive industrial demand. But the Shanghai Shield isn't just about price spreads. It's about the physics of arbitrage and the mathematics of inventory depletion. Every dollar of spread creates profit opportunities for anyone capable of moving metal from west to east. At $10 per ounce, the arbitrage profit exceeds most other trading opportunities in global markets. Here's how the physics work. If the CME succeeds in smashing the price to $70, while Shanghai holds at 93, the arbitrage profit jumps to $23 per ounce. That represents a risk-free return of over 30% just for shipping metal across the ocean. Every major trading firm on Earth would drain the COMEX vaults to capture that spread. The CME faces an impossible choice. If they smash the paper price, they lose their physical inventory to arbitrage traders at discount prices. If they let the paper price rise to match Shanghai, they admit the manipulation has failed and validate the shortage narrative driving the rally. They're trapped by their own system. The very mechanism they used to control prices for decades, the connection between paper and physical markets, has become the weapon that ensures their control fails. The vault data confirms the shield is working exactly as physics predicts. 2.2 million ounces withdrawn in a single day. The registered category dropping to 123 million ounces total. At current drain rates, the entire system empties in weeks, not months. But the Shanghai Shield isn't just defending against Western manipulation, it's actively accelerating the inventory drain by creating profit incentives that make vault depletion mathematically inevitable. Every margin hike widens the spread. Every spread creates more arbitrage opportunity. Every arbitrage transaction removes more metal from Western vaults. The Shield has effectively put a floor under global silver prices that cannot be broken by financial engineering. That floor is currently at $90 per ounce and rising daily as industrial demand in China intensifies and supply constraints tighten further. But it gets worse for the banks, much worse. While the price was being smashed on the screen, the vaults were being raided in reality. Look at the depository data released that afternoon. 565,000 ounces withdrawn from Asahi, 617,000 from Brinks, 351,000 from C&T, 791,000 from StoneX. Total daily drain, 2.2 million ounces, gone, vanished. Shipped east, while the west was distracted by red candles on a chart. This doesn't happen by accident. Someone knew. The coordination suggests months of preparation. While the Western financial media was focused on inflation data and Federal Reserve policy, a different kind of intelligence was flowing through different channels. Intelligence about vault levels, intelligence about industrial demand, intelligence about the mathematical certainty of what happens when paper claims exceed physical supply by impossible ratios. The vault drain wasn't random. Look at the specific entities targeted. Asahi, the Japanese refiner with the strongest ties to Asian industrial buyers. Brinks, the logistics company that specializes in precious metals transport. C&T and StoneX, the clearing firms that handle large institutional transactions. This wasn't retail panic buying. This wasn't momentum speculation. This was surgical extraction of inventory by entities that knew exactly where the metal was stored and exactly how to move it out of the Western system before anyone realized what was happening. The timing was perfect. The margin hike announcement hit at 11:47 a.m. Eastern. By the time Western traders were calculating their new margin requirements, the first vault withdrawal requests were already being processed. The metal was moving while the price was falling, but the sophistication goes deeper. The coordination required intelligence about CME internal processes, about G7 scheduling protocols, about Treasury decision-making timelines. Someone knew that Besant would call the emergency meeting. Someone knew the official language would mention critical minerals and supply chain security. The G7 meeting proves they knew this was coming. You don't convene the 7 most powerful finance ministers on Earth with 4 hours' notice unless the infrastructure for that meeting was already in place. The logistical coordination alone requires weeks of preparation. This suggests the margin weapon failure was anticipated. They knew the vault drain was accelerating beyond sustainable levels. They knew that Shanghai's $93 price would create an impenetrable floor under the market. The G7 meeting wasn't a response to the crisis. It was preparation for what comes after. The crisis becomes visible to everyone else. Secretary Besant didn't call that meeting to discuss solutions. He called it to coordinate responses, to align narratives, to prepare for the moment when the shortage becomes impossible to hide and impossible to spin. To discuss contingency plans for when the financial tools fail completely and political tools become necessary. And this connects directly to the G7 meeting. Because Secretary Besant knew about the vault drain, he knew that 2.2 million ounces were bleeding from the system daily. He knew that the registered category, the metal available for immediate delivery, had dropped to just 123 million ounces. That's why he called the meeting. That's why he gathered the finance ministers. That's why they started talking about critical minerals and supply chain security. They're not managing a market anymore. They're managing a crisis. But here's where the desperation becomes visible. The G7 doesn't meet about commodity markets. They meet about currency crises, banking collapses, sovereign debt defaults. The fact that they convene to discuss silver supply suggests this isn't a market event. It's a systemic event. It's a breakdown of the mechanism that's kept prices artificially contained for decades. And the language shift is telling. For 50 years, they called silver a precious metal, a shiny rock, a barbarous relic. Suddenly it's critical. Suddenly it's strategic. Suddenly it's worth an emergency meeting of the world's most powerful finance ministers. This rebranding isn't accidental. By classifying silver as critical, they open the door for government intervention. They can invoke the Defense Production Act. They can prioritize industrial allocation over retail investment. They can implement rationing, which is exactly what's happening right now. While you're reading this, Costco, one of America's largest retailers of physical silver, just implemented strict order limits, 1 transaction per membership, hard caps on units. They're rationing silver sales because they know they can't replace inventory at current prices. The U.S. Mint, the government entity responsible for producing silver eagles, just announced a 1-month delay on new orders, back-ordered. The United States government, with all its resources, cannot stamp coins fast enough to meet demand. This is the failure of the supply chain at the sovereign level. This is what happens when just-in-time becomes just too late. And in the futures market, something unprecedented is happening. Traders are fighting to stay in the delivery month. Instead of rolling their positions forward, they're grabbing January contracts because they don't trust that metal will be available in March. 369 delivery notices issued, but open interest only fell by 233 contracts. For every person trying to exit the market, someone else is fighting to get into immediate delivery. They want the metal now because they know it might not be there later. This is backwardation. This is the definition of a squeeze. The shorts are trapped, the longs are demanding delivery, and the exchange is hiking margins to force them apart. But the margin weapon is broken. The political weapon of G7 coordination is ineffective. What's left when the primary tools of market control stop working? They close the gates. They make it harder for you to participate. They ration supply. They demonize hoarders. They want the remaining metal for themselves. The system response reveals the truth they're trying to hide. If silver wasn't scarce, they wouldn't need to ration it. If the price wasn't justified, they wouldn't need to crash it with margin hikes. If supply was adequate, they wouldn't need G7 meetings about critical minerals. Every action they've taken confirms the thesis they're trying to disprove. Silver is scarce, supply is critical, the price is real. And here's what makes this moment different from every previous crisis. The Shanghai Shield changes everything. For the first time in modern financial history, the West cannot control the price of a strategic commodity. The East has created a floor that cannot be broken by paper manipulation. Every margin hike, every flash crash, every coordinated smash hits that floor at $90 and bounces. The arbitrage is too profitable. The physical demand is too strong. The vault drain is too rapid. The banks are learning what happens when you fight a physical shortage with financial engineering. You lose your inventory, you lose your credibility, you lose control. But the vault drain is just the beginning, the first domino in a cascade that accelerates with each passing day. Industrial demand is exploding on multiple fronts simultaneously. The electric vehicle transition requires massive amounts of silver for battery management systems. EV production targets for 2026 demand 200 million additional ounces annually. There are no substitutes. The chemistry requires silver. Solar panel installation is consuming silver faster than all the mines on Earth can produce it. The global push for renewable energy has become a silver shortage acceleration machine. Military demand is classified, but catastrophic for supply. Every piece of electronic warfare equipment requires silver for its conductivity properties. Each demand sector alone would strain global supply. Combined, they create mathematical impossibility. Annual demand now exceeds 1.4 billion ounces. Global mining produces 830 million ounces. The deficit is 570 million ounces annually. Mining supply is declining, not increasing. Ore grades are falling worldwide. The easy silver has been mined. New discoveries take 15 years to develop into production. Recycling cannot fill the gap. The silver consumed by industry is gone forever. Geopolitical tensions are fragmenting supply chains. China controls 30% of global refining capacity. As trade wars intensify, the free flow of silver becomes increasingly restricted. Investment demand is awakening. Major pension funds are adding silver exposure. When institutional money discovers a market with 570 million ounces of annual shortage, the buying pressure becomes unstoppable. The timing isn't coincidental. Industrial demand explosion, supply constraints, geopolitical fragmentation, institutional awakening, they're all happening simultaneously. This creates a perfect storm where every variable pushes in the same direction. At the center sits the COMEX vault system with 123 million ounces of registered silver, facing industrial demand of 1.4 billion ounces annually, facing daily outflows that are accelerating exponentially. The mathematics are inescapable. At current consumption rates, the system has weeks of inventory remaining, not months, weeks. Every industrial buyer analyzing these numbers reaches the same conclusion: secure supply immediately or face production shutdowns. Every military planner looking at these projections understands the national security implications. Every finance minister studying these trends sees economic chaos approaching. This is why Secretary Bessent called the G7 meeting. This is why they started using phrases like critical minerals and supply chain security. They can see what's coming. They can calculate the timeline. They know that when the vault's empty, when the supply chains break, when industrial production halts for lack of silver, the economic disruption will be unlike anything in modern history. This pattern has played out before, not with silver specifically, but with strategic commodities that industrial civilization cannot function without. The warning signs are always the same. Price manipulation continues until suddenly it doesn't. In 1973, oil was $3 per barrel. When the Yom Kippur War created tensions, oil producers weaponized supply. Prices quadrupled overnight. No margin hiking could change the physical reality of reduced production. In 2008, wheat exploded from $4 to $12 per bushel in 6 months. Russia and Ukraine restricted exports. Food riots erupted globally. Futures markets became irrelevant when actual grain stopped flowing. In 2010, China restricted rare earth exports to pressure Japan. Prices for neodymium increased 500%. Western manufacturers scrambled to secure supply at any price. Paper markets provided no solution to physical embargoes. Each crisis followed the same pattern. Financial markets assumed infinite supply at controlled prices. Industrial users assumed just-in-time delivery would continue forever. All assumptions proved catastrophically wrong. The silver market today exhibits every characteristic of these previous crises. Concentrated supply controlled by potentially hostile nations. Industrial demand growing faster than production. Financial markets divorced from physical reality. But silver is different in one critical way. It's more essential and more scarce. There is no substitute for silver's electrical conductivity properties in precision applications. Every computer chip, every missile system, every solar panel requires silver to function. Unlike oil or wheat, silver cannot be produced quickly when prices incentivize increased output. Mining operations take 15 years from discovery to production. Even if silver hits $200 per ounce, no new supply reaches the market until 2040. The CME margin hike represents the last desperate attempt to maintain control through financial engineering. The G7 meeting represents the moment governments realized financial engineering cannot solve physical problems. The paper system breaks completely. Physical prices disconnect from futures prices. Industrial buyers abandon financial markets and negotiate directly with producers. Governments implement rationing and allocation controls. Supply flows are determined by political relationships rather than economic theory. We're witnessing the early stages of this breakdown right now. Shanghai trading at 93 while New York trades at 83. Physical premiums exploding while futures prices are suppressed. Vault inventories draining while open interest remains artificially high. Retail rationing beginning while industrial demand accelerates. The system is fragmenting in real time. Each attempt to restore control accelerates the fragmentation. Each margin hike widens the arbitrage gap. Each G7 meeting validates the shortage narrative. Each coordinated response proves the coordination is failing. The system is discovering the difference between controlling prices and controlling supply. They've lost control of supply, which means they've lost control of prices, which means they've lost control of the market they've manipulated for decades. The margin hike was their strongest weapon. It failed. The G7 coordination was their political weapon. It revealed weakness instead of strength. What comes next when the primary tools of control prove ineffective? They change the game entirely. They move from manipulation to confiscation, from market control to direct seizure, from financial engineering to physical force. The Venezuela operation was the preview. The G7 meeting was the planning session. What this suggests about the next phase should keep every holder of real assets awake at night. When systems lose control, they don't simply fade away. They become dangerous. They become desperate. They become willing to use any tool necessary to maintain their position. The price recovered to 83.90. The Shanghai shield held. The vault drain continues. 2.2 million ounces closer to empty. 54 days of inventory remaining. By the time they admit what the meeting's already revealed, it will already be too late.